So I get the awesome responsibility of taking through a couple of case studies, and I love to geek out too. I mean, I'm a guy who's got a master's in tax and other stuff. I love to geek out, but I'm not going to try and do that to you. I'm going to try to make some stuff understandable. I get the fun part. How can we sell a business or sell an appreciated asset and not pay taxes on that sale, or pay very little, or at least defer it for 30 years. So, Wealth Legacy Group, we deal with all things of wealth. So yes, we do assets under advisement. We also have about 30% of our revenue comes from our consulting, and about 28% comes from our insurance practice and other stuff as well. So we deal with all things of wealth, but we also deal with all things of legacy. How do we get money and the values? It's about what helped to make that money in the first place. Comes from the root system of a tree. I'm a kid from Yakima, Washington. And I can tell you the most important part of an apple tree is not the apples. The most important part of an apple tree is the roots. And that's the virtues by which that family and that tree grows. If you got healthy roots, you're going to have a healthy tree and great apples. If you got bad roots, good night. Not going to last. As Max talked about, it's not going to last generationally. So we deal with legacy issues. So my goals for today, let me talk real quickly. I want to look at 3 different tools, and we're going to do a real flyby. So, buckle in here. It will at least either eliminate, reduce, or postpone for 30 years. And I also want to talk about your dreams and visions and what that looks like as well, for either for your organization or for you personally, or both. So, but first, before we get into the technical part, guys, we're all guys left in the room here, great. We love to go down in the technical stuff, the tools, techniques, the strategies. But I found over time, it helps. Oh, that's a lovely sound. They're cutting down a tree. Okay, yeah, I hope you're catching this on the video, right? Why couldn't they just use the axe? But oh well. But I've found that if I spend more time up on the mission, the vision, the values, and the goals, if I hang out above the line planning, I can do a whole lot better job, faster actually, with below the line planning, the tools, techniques, and strategies. So I'm going to ask you to float with me just a little bit on this winding river of taxes. And so for today's presentation, you just really need to get 1 point. So if you get this 1 point, you will understand my presentation. Okay, Max is going to go out and kill the guy who's doing the cutting. So here's the 1 point. You ask, what is it? Well, most wealthy, affluent Americans understand that this is a great country. We have an obligation to support the social well-being of our country. Because for all its faults, and I've been around the world in many different countries, third and fourth world, and my wife, as a survivor of the killing fields of Cambodia, we understand what it means to have freedom, and we're so grateful for America. But what most wealthy Americans don't understand is that the government gives us a choice in how we support the social well-being of the country. Now, if we don't choose, they choose for us. And what's that called? What's another name for that choice? We call it taxes. That's right. Supporting the social well-being of the country, it's with taxes. So I do bring good news, and that there is an alternative. So this is the central point of my presentation, and so if you miss some of the technical parts of the cases, don't worry. If you get this point, you got it. And that is capital gains taxes are voluntary. Federal estate tax, inheritance taxes, just as Howard so aptly pointed out, they're big numbers if you don't plan in advance, but if you plan in advance, they're voluntary. 3.8% Medicare surtax that did not go away under the new tax code. We thought it might, but it didn't. It's voluntary. As well as a third to half of your income taxes, again, are voluntary. Are you seeing a theme develop here? And that is, they're voluntary, and if, there's a big if here, if you choose to support in advance how you're going to support the social well-being of the country in a way that's in alignment with your own value system. And that's the key. You have to do this in advance. So let me give you a couple of cases where we did this. So I'm not going to bore you to death, but where this really the basis for this comes and why these cases work is because in 1969, America is truly the most philanthropic country ever in history. Our citizens of America are wildly philanthropic. And so there was a move that it culminated in the 1960s with the 1969 Tax Reform Act. And so it brought to us a whole litany of tools, what are called split interest, meaning that it's okay to do something that's good for ourselves, as long as we're doing something that's good for somebody else, a school, a church, our communities, the boys club, whatever. As long as it's good for somebody else, either now, in the future, or both, or a great not-for-profit like Terry, that it's okay if we get a benefit from it now or in the future or both, okay? And that's it. That's the point you need to get. That's what it's called a split interest gift. So again, I'm not going to bore you with a whole bunch of tools, and there's literally pages of things that came out of that bill, but I'm going to show you how we had a couple of situations where we were able to use examples of these split interest gifts to make an enormous difference in the lives of these business owners. So the first one, this isn't a business per se, but for our real estate people here in the room, especially since in San Diego we have so many people that own real estate. We do too. Tim, you'll love this one. This was a triplex. This gentleman bought this in Los Angeles a number of years ago, bought it for $500,000. It's almost all depreciated, okay? So if he sells it, he's gonna have an enormous amount of tax to pay. Fair market value today was over $2 million. And the rental income, about $52,000 a year net after all expenses. He actually, by the way, I've got to say, was really proud of that number. When I said, well, what are you making for income and net of expenses? And he kind of puffed up. But then when we started thinking about what that income represented in light of the fair market value, it was a fraction of really what that property was worth. So his wife, I love. Come on, guys. You love and I love dirt. Yeah, don't we? I got a smile on that one? Oh, okay, well. So she really had no interest at all in managing properties after ULove bit the farm. So we knew that we needed to do something from a planning standpoint. They were philanthropic to a certain degree, a minor degree. They gave money to their church and a few other charities. So we were looking at selling the property, and one of the things that was holding them back from selling the properties, not only was there going to be $100,000 in just in junk fees, all of which are earned, by the way, the commissions to our real estate advisors is absolutely every dollar is earned. Tim, is that correct? Just say amen. Yes. That's right, okay. One of our best commercial real estate brokers right here. So, but $750,000 in taxes of involuntary philanthropy on this transaction. So that was a minor heartburn, and they just really didn't want to go through a 1031 exchange, and I understand why. They're really tough. So I brought to them their attention to Capital Gains Alternative Trust. Don't look for that name on Google. You won't find it. That's my name for it. But what it does is it completely eliminates the capital gains taxes and completely eliminates the Medicare taxes. We structured it in such a way that they got 6%, so they're now in their fourth year of income, where they've been getting 6%, and it's growing. But the first year, their income was $126,000. Do you remember what their income was off before? $52,000. So we more than doubled their income, and it's growing. On top of that, they got over a $600,000 income tax deduction. And they got 6 years to use it all up, because oftentimes we create more tax deduction than we can even use up in a given year. So good news is you get this year and you get 5 more. So we get 6 years to use it all up. So what else happens? They can be their own trustee. Normally, from an estate planning standpoint, we would advise our clients to not be trustee because it causes inclusion of those assets in their estate. In this case, doesn't matter. One of the key factors on this one, though, is that it's protected against creditors. So this is California. Does anybody do lawsuits around here? Maybe it's just only in other states, but I've heard that I got brought into a case. Unfortunately, it was not my client, and I was brought in too late. Not that I could really have done much to help him anyway. He had sold his company for $10 million, took $9 million, bought leveraged real estate, and lost it all. Lost it all. Fortunately, he put $1 million into a capital gains alternative trust, and when the creditors came to go after him for the $9 million in debt that he lost, they couldn't get at this money. So it was completely free of creditors. That's important. And you can use this to sell a business, as well as an appreciated capital asset like real estate or other things. So the ultimate beneficiary of this, the reason why he gets that big significant tax deduction, is it's going to be their family giving fund. So this money, after he and his wife are gone, and he's in his 70s, she's in 65, for a 70-year-old today, what's the life expectancy? Inside some of your booklets, you'll see a little green thing that says tax. Well, if you look on the back side of it, you'll find the age And what, if you are a certain age today, what can you expect to live to? For a 70-year-old today, I'm here to tell you, it's 27.4 more years. At 97.4, half the people are dead, but half of them are still alive. So our money has to last a whole lot longer than we've ever imagined. And again, looking at this room, you guys are all gonna make it. I set my thermostat for 147. I wanna see a new century come in. So, again, we've gotta make sure our money lasts for us and is protected against creditors. So, overall score on this one, I'd give it an A. But this next idea I'm gonna share with you, I'm gonna give an A+. Ken Blanchard, who happens to be a mentor of mine, he's over 60 books that he's co-written. He used to be a college professor at Cornell, and he would give the answers to the final for his class at the beginning of the class. He'd say, look, my job is I want to make sure you guys all get an A. And so I'm going to tell you what the questions are going to be on the final so you can study and learn as you go along all this semester so you get an A on your exam. Well, that's what I'm going to do. I'm telling you in advance, this one is an A+ idea. So. This is a client I met, he and his wife coming into an elevator into a social event, so just pay attention. Next time you're in an elevator, start having some conversations with folks. You never know when that might be your next client, or donor, as it might be for Terry. So Rusty and Robbie Nail, they were selling, their share of the business was 20 million, okay? So the 20 million, there was some things in California because of the federal long-term capital gains tax of 20. The 13.3 in California, that's the state income tax because we have no long-term capital gains tax. And they're actually talking about going to 14.4 plus the 3.8 Medicare surtax. So all that, as Howard was saying, that's almost 40%. So on their $20 million sale, how much in taxes was that going to be? Almost $8 million. So what we ended up doing was a combination of ideas for them, but one of them was what I call a win-win LLC. Again, don't Google that because you won't find it by that name. That's my name for it. But it's a form of a split interest gift. Remember that I was talking about? It's okay to do something that's good for you as long as it's good for somebody else, right? So it's a form of a split interest transaction. It combines the best things that I just showed you a moment ago about the capital gains alternative trust with one major difference. One of the disadvantages of the capital gains alternative trust, and one of the biggest reasons, because I've done a lot of them, but the biggest reason if we don't do it is because there's no access to principal. Well, that's good if you're getting sued by creditors, but if you're trying to do something else and you want access to principal, that may not be so good. This one does give you access to principal. It's a different construct. So, and then whatever's left in the bucket though, after you are gone, after your spouse is gone, after your children are gone, because this can be generational, is, again, typically goes into a family giving fund. And how's it look in terms of operation? Well, I gotta say, half the clients I would show this to a few years ago, they'd say, great idea, RJ, but we wanna see if somebody else really does this. This has major notoriety, maybe we'll wait. Well, then in 2015, so a couple years ago, there was this guy, Peter, what's his name? Last name starts with a Z. And he's got that small regional company, Facebook. Yeah, that's right, 2 billion users, I heard. Mark Zuckerberg used this idea. Put in $44 billion worth of Facebook stock. Now, you can use this idea even if you don't have $44 billion. So I just want to put you at ease. You can use this idea. Smallest one we've done has been about $1 million of gain. But it works regardless of the size. It also creates, one of the things I love about this is it also creates current philanthropy now. It's not just 30, 40, 50 years from now. It gives us money that we can use that would have gone to involuntary philanthropy that now we get to use for current philanthropy. So what else to like? Eliminates up to 99% of the taxes on the sale. Oh, by the way, you can buy another business with it, which I've had clients do that. You can buy more real estate with it. So Tim, you can get paid again. You can do lots of things with this. And the nice thing about it, if you're buying real estate, there's no 1031 exchange issues to deal with, so you don't have to identify the replacement property in 6 weeks. You don't have to close the transactions in 6 months. It's a whole lot easier to live with this one. What else to like? Again, not only does it eliminate up to 99% of the taxes on the sale, and I know I'm flying fast, but it also gives you a tax deduction. This is what I call the win-win two-step, because we can get a deduction up to 80 cents on the dollar. So if you're talking about a $10 million business, or in the case of, you'll see in my client here, 80 cents on the dollar deduction, that's a huge number For my client, we ended up putting $5 million in. He got a $4 million income tax deduction. And then any money that's inside of that LLC that doesn't get distributed, again, 99% of it, there's no tax. So Joe, we were talking about that client that might be interested in helping Terry. Well, what a great way. Let's make it even easier for him, because now we can eliminate the involuntary philanthropy up front and have more money left over, not only for himself and his family, but also to give, hopefully, to Terry and others, organizations that he cares about. A lot of times, with this one, you've heard the saying, control is better than ownership in most cases. That's true on this one. Control is oftentimes better than ownership. Last one. Well, actually, I better land the plane on this one for the client. What did we do for him? We bifurcated the transaction. We did $15 million of a stock swap. So in his case, that's a code section 351. We just ended up swapping his stock for the stock of the acquiring company. What's that do? Did that save taxes? Well, yeah, indirectly. What it is, we just deferred the taxes on that one. But it was the $5 million in cash. That's where the heartburn was. And so instead of having a $2 million tax bill, we brought his whole tax bill down to about $23,000. Now, mind you, there were some enhanced deal costs. It costs more, typically 5 to 6% on these transactions, like a real estate commission. But he was more than willing to do that, compared to pay $23,000 in taxes versus $2 million in taxes. And not only that, there's control of the cash, there's asset protection as well that he didn't have before. Overall score, I already told you, it's the beginning of the semester, giving this one an A+. Now, what if you don't have enough time to use one of these two techniques? Capital Gains Alternatives Trust, great idea. The Win-Win LLC, even better. You're supporting the social well-being of the country, at the same time you're doing good things for yourself. But there's more. What if you don't have time to get one of these transactions in place, because you do have to have lead time? Well, I learned this from a friend of mine. When is an installment sale not an installment sale? So this is a tax-deferred installment sale that's a non-installment sale, because you get your money up front. So first, we do have compliance attorneys. We're an independent registered investment advisor. So we do have to give you word on this one that you need to look at this idea with your own tax attorney. So, okay, Peter, you can vouch for me that I did, in fact, put this caveat up here so our attorneys know. But if there's not enough lead time before the sale, and I've literally had some cases where we've had less than 30 days before the sale transaction was happening, and I'm losing my voice here. So what do you do then? Are there any options? Well, I'm here to tell you there is some good news. So with this particular idea, it doesn't eliminate the tax. But how many people, if you had to pay a tax bill, how many of you out there would rather pay it 30 years from now, 3-0, than pay it now? Okay, yeah. The only people that didn't raise their hands were looking and checking their phone or asleep. Absolutely. I'm going to choose to pay it 30 years from now. Why? Time value of money, if for no other reason, right? So you get, and plus you get up to 85 to 90% of your cash within less than 30 days of closing. So how does this work exactly? I can't get into the mechanics for a couple of reasons. Number one, we don't have the time. Number two, I'm on a non-disclosure agreement with the law firms that develop this. But it's like with a 1031, you have somebody in between that takes the money and holds the money for you. Well, that's kind of what's happening here. They get the funds on your behalf. They then are used to buy a replacement asset, and no tax on that money as it's held there. In this case, we're just simply deferring it out for 30 years, similar concept. So again, you're not going to find this on the front page of the Wall Street Journal, trust me, because the law firm that developed this concept doesn't want a whole lot of people knowing about it. The team of other tax advisors and geeks that I work with, we've done now close to 10. So it's not without controversy, but again, for some larger transactions and where it works, you can defer up to $5 million of gain per person. So husband, wife, $10 million of gain. If the kids are involved, adult children, you can have up to $20 million of gain. So again, recognize that you're going to have tax to pay, but the tax gain doesn't get worse. So if you got a $10 million taxable gain, that's what you're going to report 30 years from now, whatever the tax rates are at that time. So if tax rates are higher, you're going to pay a little higher tax. But again, time value money, no big deal. If it's lower, guess what? Winner. So there you have it. 3 alternatives to paying taxes on the sale of an appreciated asset or on the sale of your business. the capital gains alternative trust, the win-win LLC, or the tax-deferred installment sale. So the two ideas, first two, make capital gains taxes completely voluntary. The last one, where I've got a client right now, we're working on a case where his goal is to get as much tax deduction as he can this year. He generates between $1 to $2 million of income every year, but in this particular year, he's going to have a liquidity event on some public, it's privately held stock now, but they're going to market. So he's looking at having potentially another $7 million of taxable income this year on top of the 1 to 2. Well, one of the things in the new tax bill is that you can make a gift to charity. It used to be, if you made a gift of cash, you get a deduction of how much? What was the percentage before? If you made a cash gift, it was 50% of your income. So you could gift cash, take a deduction for up to 50% of your adjusted gross income, now called modified adjusted gross income, or MAGI. Well, under the new tax bill, that number changed. Down or up? It went up. It's now 60% of your modified adjusted gross income, or MAGI. There's a little catch to that, though. If you give anything else, like stock or appreciated assets, it actually reduces the amount you can give away. Like, okay, go figure. But, so what we're thinking of for this particular client is, we'll sell his stock, use the 30-year deferral of tax, get a big chunk of cash, and that way he can go ahead and write a big check, which was his plan anyway, but he was going to give stock. In this case, we'll write a big check and get a deduction for 60% of his income instead of only, in this case, 30% if he gave stock. So we've doubled his deduction and enabled also some wonderful things to happen in our community as a result. So, simple point, think about other alternatives, and that's why we're here. That's why Howard and Max and Sal and I are doing what we're doing and creating this master plan for the business owner. And oftentimes, it's not just one idea. So forget the silver bullet idea. It's usually a combination of ideas. 1, 2, 3 of these ideas together. So, as a recap, Max Bulka talked about how to leave your business when, how, and whom you want for the money that you want and need. We had Howard Nieswander talking about how do you build value before you sell so you can get the maximum amount when you do sell and transfer your business. We had Sal Capizzi talk about, hey, why not have your investment manager on the same side of the table with you so that he or she gets paid when you're making money? And if you're not making that money that particular quarter, why should they get paid? I love that concept. Okay, that's a great one. And then for me, we're talking about it, capital gains are voluntary and other taxes as well. So that's what we call master planning for business owners. And with that, thanks for letting us share with you today. We love being here. We had a big crowd yesterday at UTC, but I personally was looking forward to today the most. Love this setting. I knew the people that were going to be here. The people are here exactly some of the favorite people I was hoping were going to be here. So it was good to see you. And again, thanks so much for having us with you. Hot Topics for Business Owners is more than that. It's about also leaving a legacy. Every day we get a chance in terms of the legacy we're living and leaving behind. So John Wooden, the famous basketball coach for UCLA, used to say that you've never lived a perfect day unless you've done something for someone else who can't repay you. You have not lived a perfect day unless you've done something for someone else who cannot repay you. So what's your legacy going to be? If God forbid, if you were taken out today, what's the legacy that you're leaving behind? Today, every day, we get a choice and a chance to make a legacy that makes an absolutely lasting positive impact in the lives of those you love and the world around you. So again, R.J. Kelly, on behalf of Max Bulka, Sal Capizzi, and Howard Nieswander, thanks so much for being with us. God bless.